Once we finally pick a portfolio allocation that aligns with our goals and our personality, the next step is figuring out the investment vehicle you'll use. There are so many options, but just understanding the basic 7 will get you a long way. Today we'll hit the highlights of the most common and popular investment products, and that's next. Welcome to the RhinoInvestor.com educational series. Like and subscribe to charge along with us. First up is stocks. If you hear the word equities, it's the same thing. Stocks represent ownership in a publicly traded company. Publicly traded means you can buy and sell these companies on exchanges like the New York Stock Exchange and the NASDAQ. Stocks are bought and sold in shares, and they go up and down in price over time, known as fluctuating. Some stocks pay dividends, some do not. Typically, you do not pay tax on stock gains until you actually sell them. Any dividends received while holding the stock are taxed each year, but usually get a preferred tax rate. Stocks can be made up of large companies, medium companies, small, local, or overseas. If you hear the word blue chip, it's referring to a large, established, well-known company. Stocks can be in any of the 11 sectors in our economy: healthcare, financials, energy, technology, consumer staples, consumer discretionary, utilities, materials, services, industrials, and real estate. Stocks are best for investors who actually enjoy picking individual stocks or really like certain companies and want to own it specifically. They desire lower fees because individual stocks don't charge a fee to own them. Stock investors have more control over taxes because they don't pay on gains until they sell normally. And stocks are best known for growth investors, but some high dividend stocks are purchased for income. And lastly, the individual stock owner does not mind the increased risk that comes with owning that individual company. Next is bonds. Owning an individual bond is like having an IOU with interest. You actually loan money to a company or government, receive interest that pays twice a year, and there's an end date called the maturity of the bond. Bond interest cannot be reinvested generally, and the price of your bond will fluctuate over time until maturity. So if you were to sell it early, it could be at a gain or a loss. Bonds are normally sold in even lots of 5,000, 10,000, or more. I find what trips up investors most on bonds is terminology, but once I draw out what an actual bond looks like, it usually makes more sense. Back when bonds were issued on paper, they had these little coupons attached with dollar amounts and future dates. The front of the bond would list the company name, the rate of interest it paid, and the amount due at maturity. The company name is called the issuer. The coupons on the side and the rate of interest on the front represent the coupon rate, and the amount paid back at maturity is called par or face value. The trickiest part comes next. You may buy this bond at a premium, or more than $10,000 in this example, so the yield on the money you invest will be less than the coupon if you paid a premium, and more than the coupon if you paid a discount. There are more details to bonds, but knowing these terms gets you further ahead than the average investor by far. Individual bonds are best for investors who prefer those coupons, so they know exactly what their income will be and when they'll get it. They also prefer to know they'll get their money back at maturity if they bought a high-quality bond. And speaking to that, these investors also want to know exactly what company or government bond they own. And because some bonds pay income that can be tax-free, it attracts those clients as well. Mutual funds are next. Mutual funds are a portfolio of pooled money that issues shares in which you can invest. Mutual funds can be made up of just about anything, or a mixture of investments. They can be very diversified and have many holdings, or they can be more concentrated. But the main thing is that each mutual fund has a stated objective. Shares do fluctuate daily, and they only price at the end of the trading day. Buys and sells can be in shares or dollars. Some mutual funds pay dividends, some do not. If dividends are paid, they can generally reinvest. Taxes are more difficult to predict because as the portfolio in the fund has gains, it is required to push them through to the shareholder, whether the shareholder sells or not. Mutual funds can be best for investors who prefer professional money management and don't mind paying a reasonable management fee for it. The mutual fund investor knows what they want to accomplish, but either they don't know exactly how to achieve that goal or they don't want to do it themselves. Mutual funds also provide more diversification typically than just holding on to a few individual holdings. Now, exchange-traded funds, or ETFs, are very similar to mutual funds. I find the main reason an investor would prefer an ETF is to be able to trade the fund during the trading day. They don't have to wait until the end of the day to buy or sell. Also, another popular option for investing in ETFs is sector investing. For example, say you really think the energy sector will do well, or you may want to invest in water technology or anything specific, but don't know which individual company to pick. You'll probably find an ETF that invests in all those stocks in the group, thereby allowing you to invest in your idea without individual company risk. Commodities are next, and they're an interesting group to discuss. In general, commodities are hard assets that can be grouped into three main categories: oil and gas, precious metals, and agriculture. Commodities tend to have long-term cycles and can go in and out of favor, but when they're in favor, investors who flock to them without considering how the actual investment vehicles work can be in for a surprise. Mutual funds and ETFs are allowed to invest in both commodity futures directly and stocks of companies that benefit from rising prices in commodities, and the name of the fund alone may not tell you which one it is. Funds that use futures have additional pricing risks. These risks may come with more reward potential, but I've seen many investors not understand the extra risk up front. Additionally, ETFs that use commodity futures can cause a lot of confusion for the investor that doesn't understand how they're priced in the long term. They also often come with K1s, which can be a surprise at tax time. Make sure to do your homework on these vehicles, consult a financial professional, or stick to funds that only buy commodity stocks. They can help during inflationary times. Next in line of the most popular and common investments are annuities. I would say they're also very misunderstood, because while they're all issued by insurance companies, the name annuity can be used to talk about four very different things. Let's start with deferred annuities, which are not purchased for income. A fixed deferred annuity is principal guaranteed by an insurance company that is further backed up by a state. The rate of interest it pays can be set or indexed to a market. Once you buy into an annuity, it will usually require an initial holding period to avoid selling penalties, but it's also typical for an annuity to allow a little principal out each year for free if you wish. Any income received is deferred until taken out, and these assets are passed by beneficiary, not by will. A variable deferred annuities principal is not guaranteed because you usually invest in sub-accounts that are like mutual funds, and those fluctuate. The benefits to a variable deferred are mostly tax deferral, death benefit to a beneficiary, and creditor protection. Holding periods and inheritance rules are the same as the fixed deferred. Then we get to the income annuities, also called immediate annuities. The fixed immediate is really most like a traditional pension replacement. You normally exchange your principal for a guaranteed income for life. The fixed annuity side in general, deferred or immediate, is usually the lower fee, simpler, and easier to understand side of the annuity world. The variable immediate typically will have a higher income than the fixed, and it too will generally be guaranteed for life. But the fees and extra options on variable immediate annuities require extra attention. A lot of homework can be involved in variable immediates, or lean on the skill of a financial professional you trust. Variable annuities can be exactly what many investors are looking for. This group, however, can be more complicated and has a reputation for being sold incorrectly or not being fully understood. Used correctly, annuities can add security that other investments simply cannot. Well, after all that, we end with a simple one. Whew! Yes, bank deposits are investments too. And remember, you can often purchase some of these, like CDs, in your brokerage account too. The FDIC limits are the same. Just be sure to check current limits on FDIC insurance for each account title and make sure you're covered. We all need short-term cash, and most often, if you're going to need cash for something in less than a year, keep it simple and use a bank deposit. Thank you for joining me today. Join us next time for Series 3 when we talk about different account types like Roth IRAs, 529s, and trusts. See you there.